All right, today we're breaking down the latest earnings call from Onity Group for Q3 2025. And what a call it was. We're going to look at how their core strategy just absolutely knocked it out of the park this quarter. And more importantly, how management dealt with a pretty big concern that was hanging over the stock.
Okay, let's just jump right in with the headline number 25%. That's their annualized adjusted return on equity. I mean, wow. This number didn't just beat their guidance, it completely blew it out of the water. It tells you their business is just firing on all cylinders right now. So the big question is, how'd they do it?
And when you zoom out and look at the whole picture, that strength was everywhere. You've got adjusted pre-tax income coming in hot at $31 million. Book value per share? Yep, that's still climbing, up 5% from last year. But here's the real kicker. Origination volume hit a record high. We're talking a massive 39% jump year over year. Just incredible stuff. So numbers like that don't just happen by accident, right? This wasn't some fluke. It all comes down to Omniality's core strategy, what they call their balanced business engine. Let's pop the hood and see how this thing really works.
Okay, so the secret sauce here is this really clever inverse relationship they've built between their two main businesses. You see, when interest rates fall, which is exactly what happened in Q3, their originations business just takes off. Everyone wants to refinance, right? But that's actually a bit of a headwind for their servicing business. Now, flip that. What happens when rates go up? Well, it's the complete opposite. Originations cool off, but their big portfolio of mortgage servicing rates, their MSRs, suddenly becomes way more valuable. It's like a perfect natural hedge built right into the company.
And you don't have to take my word for it. The CEO, Glenn Messina, said it himself on the call. He made it super clear that this quarter's great results weren't a surprise. It was the model working exactly as it was designed to. This thing is built to perform no matter which way interest rates are heading, giving them this stability that is just so key to their whole game plan.
And here's where you can really see the power of that engine at work. I mean, look at these numbers for originations. A 39% jump from last year and 26% from just the last quarter. That is a huge beat. They're not just keeping up with the industry, they are leaving it in the dust. This right here was the main reason their earnings were so impressive.
All right, so the call wasn't all sunshine and record numbers. There was this one big cloud hanging over everything that management absolutely had to talk about. It was on every investor's mind, the loss of a major subservicing contract with a big client named Rhythm. So let's dig into how they handled that. So yeah, this is the big question, right? Losing a major client, especially one you've worked with for almost a decade. I mean, on the surface, that sounds bad, like really bad. So what did management have to say? And more importantly, what's the actual damage to the bottom line?
Well, what management did was pretty impressive. They just calmly and systematically took this whole concern apart, piece by piece. First off, they pointed out that the Rhythm portfolio was less than 5% of total revenue. Okay, not so big. Then, they revealed it was one of their least profitable deals. In fact, it actually lost them money the last 2 quarters. And get this, it was a huge headache, responsible for over half of their delinquent loans and legal issues. So the non-renewal? It wasn't a shock. They saw it coming, they planned for it, and they're totally confident they can replace those earnings with much better, higher margin business. Okay, so with that Rhythm issue pretty much put to bed, the conversation naturally shifted to the future. And you could just hear the confidence in management's tone. Their updated guidance paints a really clear picture of where they're steering this ship. So here's what you really need to know about their outlook. The big news, they've officially raised their guidance for return on equity for the whole year. They're now expecting to come in above that old 16 to 18% range. But at the same time, they did slightly lower their growth target for their unpaid principal balance, or UPB. That's just the total value of the loans they service. And, there's a really smart, strategic reason for that. And that reason is all about quality over quantity. See, they're making a deliberate move to focus on areas with better profit margins, like commercial subservicing. What that means is they don't need to chase as much volume, as much UPB, to make the same amount of profit, or even more. It's a classic strategic pivot towards smarter, more profitable growth. So let's put all the pieces together. What's our takeaway from all this? Based on the whole call, here's our take on what comes next for Onity Group.
So our thesis here is pretty simple. First, that originations business is the absolute engine of the company right now, and it's just crushing it. Second, their balanced model is proving to be the perfect strategy for this exact rate environment.
And finally, management did a masterful job of taking that rhythm contract issue and just turning it into a non-event for investors. So, what do we expect to see next quarter? Honestly, more of the same. We're looking for those strong originations to keep firing, pushing their ROE well above that old 18% ceiling for another quarter. And we expect that book value per share to just keep on its steady march upwards.
And what about the stock price? Well, we see a pretty clear path for it to get re-rated higher. As the rest of the market catches up, as they really digest this improved profit outlook and realize the rhythm contract was no big deal, that valuation gap between Onity and its peers, we think that's going to start to close.
So you add it all up. A fantastic quarter, a business model that's clearly working, really sharp risk management, and a great outlook. For us, the rating on Onity Group is a clear outperform.
This is not financial advice.